Now, if you look at what the market's saying right now, compared to what business surveys are saying, according to the market, the underlying economy looks a lot stronger than business surveys tell us. And maybe the mood has been affected adversely by all these media headlines, which are telling us it's the end of the world, when the market kind of realizes, no, it isn't.
Michael Howell, CEO of CrossBorder Capital and also author of the book and the Substack, Capital Wars. It is so great to welcome you back to the show. Great to see you as always, Michael. It's been way too long.
Well, Julia, it's always a pleasure to be here. There's certainly a lot going on in markets right now to talk about.
There is a lot going on in markets, and I can't believe it's been 7 months since our last conversation, Michael. Right. We cannot let that much time pass. I had to go back and look, and I could not believe it because you're right. A lot has transpired in the markets. And since it's been about 7 months since you were last on, when we last spoke, you were warning about that we were late in the liquidity cycle, starting to flag that end game. Let's kind of start where we are today. In that liquidity cycle, where you see things headed, what's been on your radar of late, what's your outlook? Because I know that's how you look at the world and the macro picture. So let's start big picture where we stand today. And as you know, Michael, you can take all the time you need to set the table.
Okay, thanks, Julia. Well, let's kick off, and I'm going to put a slide up that you can see, which is basically looking at the World Stock Market Index, the MSCI World, and global liquidity. And the point about the chart is really to say that one of the most important drivers of risk assets worldwide is the flow of money into markets. I mean, it seems common sense, but it often needs repeating. You've got to understand the direction of money flow because that's really what's driving asset markets up and down. You can see the fluctuations and you can see how stock markets going to react both on the upside and on the downside. Now, the concern we've had, which is kind of highlighted in this schematic diagram, is that this is how we think of the world. So we think of it as being cyclical. I mean, clearly there are trends we've got to recognize, but it's so often the case that sort of a trend narrative that often captivates an investor community gets sort of sat upon late cycle by a fierce cyclical downturn. And everyone's sort of left holding what turn out to be pretty disappointing investments because the downswing of the liquidity cycle becomes so important. And that's really what we're concerned about now. I mean, there's a lot of, decent trends to buy into in markets. One is the so-called debasement trade, the fact that gold is going up a lot, maybe Bitcoin is a long-term winner, all these things. But you've got to recognize that there's a cycle of money flow as well. And what this diagram is principally saying is that it moves in waves. Those waves are, as we'll see, probably a 5 to 6 year cycle. We are very late in that cycle. In other words, we've been moving up in the up wave for pretty much the last 3 years or so. And we're coming to an inflection point. And if you look at the peak of that cycle on the left-hand side, where we show asset allocation cycle, it says there commodity markets always do well around the peak of the liquidity cycle. And that's principally because after throwing so much money into markets, it spills over into the real economy, and the real economy begins to get traction, and consequently commodity prices start to move up significantly. As you flip over the cycle, and let me just maybe reiterate that cycle is a cycle of asset allocation. So it's moving from equities to commodities to cash to fixed income. As you go on the downswing, you tend to get yield curves demonstrating what are called technically bear flattenings. So the whole curve, the term structure flattens from what is normally an upward sloping shape. It flattens and the curve basically tends to rise across its length. So yields tend to move up, but shorter term yields are moving up faster. And that's why you get this flattening. And in that phase of the market, you really want to be short duration. You want to be looking much more at maybe short to mid duration government fixed income, hold a lot of cash, in other words. And you want to be moving within the equity market towards later cycle areas, like maybe consumer staples, utilities. Commodities could still do well in this phase, but we're getting late in that particular regime of the market. So in our view, we were in that transition. And I think I said 7 months ago that we were in that commodity phase. And that's what we're evolving through now. We've got to start looking at the data to see where we are and how the cycle is rolling over, and maybe why the cycle is rolling over. So the first thing to say is I don't think much has changed in terms of the picture. We've moved further around the clock. In other words, the clock is ticking. The asset allocation clock has moved on, but we're 7 months further on. So we're further down that down cycle, and there's more and more evidence that liquidity, which drives the cycle, is rolling over. And that's really the point that I guess we're making overall.
When it comes to like the current state of the markets and I guess like what we've seen in markets, I saw you characterize the rally as phony. And I would love to hear more on that and how that ties back to where we are when it comes to, global liquidity.
Yeah, let me dig into that, because I think there's a lot of, we need to scratch our heads a lot here, because there's some sort of puzzling anomalies which are going on. And the first chart I put up here, which is showing, as it's titled, World GDP, it's a daily estimate that we've comprised using an AI-based technology, which basically feeds in lots of inputs from commodity markets, from forex markets, from credit markets. And it basically synthesizes their data and says, given those inputs, what would we expect or project world GDP to be at any one time? And that tends to be actually a fairly decent metric, a fairly good measure of what the underlying tenor of the economy or tone of the economy is doing. And what this is showing is the past, 18 months or so, and it's basically illustrating, first of all, the effect of the tariffs, the big drop down, almost exactly a year ago, maybe a tad over a year ago now, where you saw that V-shaped drop. And, that clearly had a big shock, or that was a big shock to the world economy. The world economy recovered quite quickly when maybe Trump did his famous taco trade, and things basically leveled out again. And now what we're beginning to see is maybe the similar evolution. The great surprise is that if you look at the data which goes into this model, clearly it's come down, but it hasn't come down anything like as much as we saw a year ago. And actually, if we rolled this back to the COVID crisis, the drop then was something like, 400 basis points. In other words, 4 percentage points, which actually took that orange line way off the bottom of the graph. So COVID had a massive effect. The tariff impact was big, but this doesn't seem to be that significant. And I find that puzzling, given the rhetoric that's coming out of market commentators and the media. But on the other hand, markets seem to have sort of sailed through this relatively comfortably. So maybe Mr. Market knows a lot more than what the media are suggesting. And I think that's kind of the puzzle that's going on here. So in other words, the world economy, looking at the data, the latest data, and this is really, reinforced by current nowcast estimates, seems to be a lot more robust than maybe many economists were originally giving it, were suggesting. So I think that's what number one puzzle. The other thing to say is that if you look at the market, and this is a very interesting chart to ponder, because this is the chart that Stanley Druckenmiller allegedly always looks at to gauge the tempo of the world economy. And what it looks at is the black line is the performance of cyclical stocks relative to defensive stocks. And the orange line is the world business cycle, which is essentially put together by gathering all reporting business surveys. So the US ISM survey, the Japanese Tankan, the IFO survey in Germany, INSEAD in France, etc. Aggregating those together, weighted by economic size, and put into an index which gives you the orange line for world GDP, or world economic activity. And what this is basically demonstrating is that the stock markets are a pretty remarkable predictor of what's going on in the real economy. I mean, maybe not surprisingly in a lot of ways, the market kind of gets it right. Now, if you look at what the market's saying right now, compared to what business surveys are saying, according to the market, the economy, the underlying economy, looks a lot stronger than business surveys tell us. And maybe the mood has been affected adversely by all these media headlines, which are telling us it's the end of the world, when the market kind of realizes, no, it isn't.
Hey everyone, I hope you are enjoying this interview. If you can, take a quick moment and hit that subscribe button. We're on a mission to hit our next goal of 100,000 subscribers, and your support could really help us get there. Thank you so much and enjoy the rest of the interview. Okay, so the market is saying, it's telling us it's stronger. When I was listening to you earlier, and I want you to explain this because I have not fully wrapped my head around it. You were talking about like the financial economy and it can spill over into the real economy. Mm-hmm. Is there a relationship there, or am I totally off on that?
No, I think you're absolutely right. And I'm just about to show, if I can move up here, a chart. This is showing our index in orange of global liquidity. And the black line is that same index, the business confidence index, that is, of the world business cycle. Now, what you can see, and I've cheated a tad here by moving the black line forward a little bit, only a few months, but that just makes it easier on the eye. But effectively, you get the same idea. But what's happening is that all money that is anywhere must be somewhere, and it can't be in two places at once. So if you think of two spheres or two pools of cash, one which is in the real economy and driving economic activity, and the other which is in financial markets and driving asset prices up or down, you can see that if money is in one place, it's not in the other. So what this is showing is a sort of completely, opposite cyclical move between the real economy and the financial sector, if you like. And our orange line of global liquidity is a measure of money in the financial markets. And that's a very important thing to stress. It's not M2 or M3 or some monetary aggregate which measures retail bank deposits across all uses, real economy and financial. This is a dedicated measure of financial liquidity. And what it's showing is you get these opposite movements. Now, what the data is purportedly telling us is that the fact that the world economy is recovering, and bear in mind that black line may be drawn too low in the sense that we just saw, looking at the previous chart on stock, what the stock markets are telling us about economic activity. Maybe it's a lot stronger than that. And in actual fact, that explains quite well why the orange line is coming down. Now, the reason for stressing this is that there is really no evidence right now that central banks are tightening. They may have to. I mean, that's not a question. The fact is they may have to, but they're not doing it right now. What's happening is that private sector liquidity is draining because of the stronger real economy. Now, I'll come quietly and accept that higher oil prices are not good. And it may be that disruption because of the Iran turmoil is going to cause the world economy to slow down in the future. But what I'm saying is it's not happening now. And the stock market seems to be registering that. And maybe, and I'm saying maybe, we're such a service-orientated economy and we're so powered by government spending now that maybe movements in the oil markets are having even less effect than they've had historically, or increasingly less effect. And that
is interesting. Reality. Yeah. Huh.
Now, just to reiterate this point about the liquidity cycle, which I think is worth bearing in mind, is that if you look at where we are in this cycle, and the black line is a measure of momentum in that cycle. So it's basically saying this is an underlying growth rate of liquidity going all the way back to the 1960s here. What it's showing is that there's a fairly regular cycle, and that cycle tends to be of a length of about 5 to 6 years, or that sort of magnitude. The sine wave that we've put there, you can see in red, it actually was estimated about 25 years ago, and we've just rolled it on into the future, and it seems to line up remarkably well. Now, what it's showing is the exact trough of that cycle in late 2022. It seems to have got the peak correct around about the end of the third quarter of 2025. And it's showing that liquidity is in a process of falling and is slated to bottom sometime in 2027. So in other words, this pain of reducing liquidity is going to continue for some time, and we've got to adjust our asset allocation accordingly. And the point about this is that this is not trying to react to a day's events or a week's events. What this is trying to say is to set your asset allocation over a 5 to 6 year period in a consistent manner. And that's really what we're trying to do. So we're trying to sequentially move our portfolios and our risk allocations accordingly. Now, just to reiterate that point, one of the things that we have recently developed actually it's taken several years for us to do this, but we've basically looked at our systems and made them a lot more granular. So all the data feeds that we get that we used to look at on a weekly or most often monthly time frame, we can now do that daily. And this is one of the advantages of technology, because we can now use processing, a lot more processing in a more efficient way. And what this is showing is a flash estimate of global liquidity day by day since August of last year. And the dotted line is just simply a 10-day moving average. But it's basically showing how liquidity, funding liquidity in markets, is basically evolving through that period. And what you can see is that it's progressively going down, and it aligns very much with that cycle that we've just seen previously. But this is the granular daily data. So you can see this downward move. Now, the interesting point is that if you look, for example, at a companion index, which is using the same methodology, but here singling out what the Federal Reserve is doing on a daily basis, this is what you get. Now, again, the Fed can make changes on a daily basis and it can be spiky for sure. But again, if you look at a 10-day moving average, which we show, it shows the evolution of what the Federal Reserve has been doing. There's been no question at all that the Federal Reserve has added liquidity really since about mid-December of last year. That's absolutely plain. They've added actually quite a lot of liquidity, somewhere of the order of about 500, maybe even $600 billion. And that is part of that program that you'll be familiar with, which is the reserve management purchases, the RMP, that was effectively put in late last year to reduce the turmoil in the repo markets. Another QE exercise, although of course they refused to admit it was a QE, but clearly it is. And that has had some effect, but that is not enough to detract from declining private sector liquidity. And the whole point here is not central banks tightening that we're seeing. What we're seeing is the private sector using more cash for working capital. Now, that could be because of a stronger economy. It could be because of higher costs coming through because of elevated energy prices. It could be a number of factors. But the point is that all money that's anywhere must be somewhere. And if it's in the real economy, it's not in financial markets.
Okay, so just to reiterate, you see global liquidity may not bottom until 2027.
Correct.
So that I guess you could say that's kind of a long time. It seems like time flies, but that's a bit of a long time. So I guess my question for you, Michael, is how do you make sure you're correctly positioned or stay correctly positioned rather and not get whipsawed in the event of these relief rallies, if you will?
Well, I think the first thing to look at is to say, well, okay, one single set of indicators may be wrong. The analogy is that, can you play a round of golf with one club? It's very difficult. You need a bag full of them. And so you need different pieces of evidence to try and corroborate, what we're seeing. And what this is showing here is what the bond markets are doing. Now, there's been a lot of, I think, misguided talk coming out of the media, trying to suggest that bonds are really out of fashion and they're selling off, furiously. And, this is not the place to be. I kind of take a contrary view to that, because what the bond market is telling us is actually something very different. And if you look at fixed income, and I know a lot of people's eyes glaze over when you start to get into
not on this. They like it. They can be a little wonky on this channel.
Okay, well, let's be wonky. What this is basically looking at are the two main components of a bond. And if you look at bonds, you can break them down into a policy, an expected policy interest rate. In other words, what the Federal Reserve is likely to do. And the other component is a term premia. And the term premia is really an extra compensation that investors would demand for holding a bond or holding interest rate risk over the term of the bond. And that's the orange line. Now, if there is heightened demand for bonds of certain durations, their term premium will come down. Okay. If people don't want bonds, their term premiums will go up. In other words, that in order to hold the bond, you've got to pay the investor a bigger and bigger and bigger cushion. So if that orange line is coming down, it's saying actually there's increasing demand for fixed income. And what this is showing is that the reason that bond yields are going up at the longer end, or when they were, was largely because of changes in expected policy rates worldwide. So you can see that black line, and that has increased, and that's measured on the right-hand scale. So there was something like a 50 basis point increase in policy rates that was being discounted across world markets by investors. And there was similarly a drop, not of the same magnitude, but maybe 300 basis points in terms of term premium. But it's that difference which is important. Now, if we drill into the various markets, this is showing how consistent this is really across the world. And this is looking at how terminal policy rates across the various market areas have increased. So what you can see is you can probably make out the different colors. The bright red is the Federal Reserve. The darker red is the UK. The dotted red is China. Eurozone average is the orange, and Japan is in black. Now, what I'm going to stress here is that don't read this as Fed funds futures, because it's not. This is basically extracted from the term structure, looking at the composition of forward rates. So it's giving an indication of the direction of rates, much more than the level, although there's obviously some information about level too. But if you look at that, what you can see is the market's been discounting big increases in European interest rates. They've been discounting increases both in the UK and the US, some in Japan, but Japan is more a secular trend, and maybe China lately is kind of flatlined. But once you get to term premia, you get a very interesting difference. And this is showing changes in term premia across the major markets. And what this is saying is this is looking at the demand for safe assets. So if these lines drop, hopefully you're following me still, if the lines drop, it's showing an increasing demand for safe asset bonds. And what you can see is right across the world, with probably the exception being Japan, possibly China, but certainly Japan. With that exception, every other market is seeing heightened demand for safety among bond investors. Now, the question is, why is this happening? And my reckoning is it's happening because we're late in the cycle. And if I revert back to the original chart right back here, you can see as that cycle rolls over and you move into what we describe as a speculation zone, which is where I think we are now, you want to be getting more and more defensive. And that's what I think bond investors are broadly doing. Interestingly enough, that phase of the cycle is one where economies are strongest. So maybe what we're saying here, and this is why I think there's a lot of head scratching needs to be done, is that maybe the underlying tone of the economies coming into 2026 was a lot stronger than people were believing. That's certainly the message coming out of the stock markets and the relative performance of cyclicals versus defensives. And the Iranian tension, what there has been, has basically dented but not flattened that. And that maybe is the story. So in other words, the overall investment cycle is intact. The idea of rotating into different sectors is still very much there. And we've just got to, effectively look through the noise of the last 6 weeks and believe that what is dominant is this liquidity cycle and not the near-term geopolitics. In fact, the geopolitics in the long term tend to iron out in markets anyway. It's very, very difficult to see their footprint.
So just to reiterate, though, the bonds, as you put it in your Substack piece, are pointing the way. What are they signaling? Do those tend to signal earlier before everything else, of like the direction of where things are headed then?
Yeah, very, very much. I mean, let me give you an example. Maybe here is a very good example. This is looking at the yield curve. Okay, the black line here is the average US Treasury yield curve slope. It's not the 10-2 or the 1-5 or the 5-3. It's actually everything. It's the area under the yield curve. So it's really an average across all those different maturity spreads. And the reason we're doing that is that one or two may be biased, but the average of the lot is going to be a clean measure of what the slope of the term structure is. And this is basically saying that if you look at the term structure, the black line, if it goes up, that's a steepening of the curve. If it comes down, that's a flattening. And what we've put on top of that is our measure of US liquidity. So this is a rate of change of liquidity across US financial markets. Now, what you can see is that we've also advanced that line by around about 9 months. So in other words, the orange line is predicting what the yield curve should be doing. Now, I haven't cheated by starting in 1990. In actual fact, it goes way back right into the 1970s, this same relationship. It's something that I used to use at Salomon Brothers years ago to try and understand the movements of fixed income markets. And basically, this is really telling us that if there's lots of liquidity in the system, the demand for safe asset bonds is low, because you don't need safe assets in an abundant liquidity environment, because effectively, there's limited risk around. So you can effectively go into equities or corporate debt or whatever. You can take risk as an investor. But as you start to see liquidity dropping, systemic risk starts to rise. The risks of default will increase, and therefore you need the safety of more government debt, which is ultimately the safe asset. And what happens in that environment is you tend to find that the demand for duration goes up and the yield curve will start to flatten as term premia drop. And you can see this feature here. Now, as recently as probably mid to late January, the consensus trade right across markets was that yield curves were going to steepen throughout 2026. Our view has been that they would begin to flatten from about mid-year. And okay, they're poised now, and we could be wrong, but it looks as if you're getting that turn. And that turn is all about the liquidity cycle. So what I'm saying is fundamentally is, with all due respect to what's happening in Iran, maybe the dominant feature here is the liquidity cycle, and that is rolling over. And it's rolling over because the real economy is basically absorbing more money from more funds from financial markets. I mean, clearly that could be because of heightened defense spending, more funding needed, etc. I mean, I come quietly to that. That's probably a reasonable assumption. And central banks are not really plowing a lot more cash into markets, with the exception of this short-term move that the Fed has made.
Okay, this is interesting. As you also put it, we're firmly in that speculation phase right now.
Correct.
So I wonder, Michael, people might feel pretty good still in a speculation phase, but the next phase is turbulence.
Correct.
So it sounds like maybe you need to be careful in this phase about feeling good, buying into relief rallies, if you will, because you need to be set up and ready for when we hit turbulence as we move through the liquidity cycle here. Is that fair to say?
Yeah, I think that, absolutely correct. I mean, the point we're trying to make here is that, think of this like the seasons or whatever it may be. And, if you're moving into winter, and let's take the analogy that turbulence is winter, you're not going to go outside in a swimsuit during winter. I mean, you might try, but then you'll come indoors pretty quickly and grab a coat. And the analogy that's the analogy we can draw. You can test the waters or test the weather if you want, and try and do that when you're in winter. But you're going to effectively, change your stance pretty fast. And what we're saying here is that this winter period is going to last many, many months. And so you don't want to be trying to double guess the markets and saying, well, I don't believe that we're in winter. I keep, it's summer, it's summer, it's summer. I mean, you can say that as much as you like, but the fact is that the climate has changed, and therefore you need to invest accordingly. So by all means, one can say, we're going to be wrong, and maybe that's right. And people are saying, well, okay, you are wrong, it's going to be summer. All we're saying is you've got to think about context. And our argument is that we're moving into a more difficult phase, and you should see that evidenced in market responses. And that's why I said, you look at the evidence. The equity markets seem to be confirming what we're saying. The bond markets seem to be confirming what we're saying. The liquidity data seems to be confirming what we're saying. The pattern of the economy seems to be confirming what we're saying. So that's where we are.
And so that also involves reducing risk, rebuilding bond duration. The bond part's interesting. Favoring gold. I know we've talked about gold. We've also talked about Bitcoin too. I would love to get your latest there. And And then you were mentioning earlier, like moving more into like staples, for example. Like, can you just elaborate a bit more, like the asset allocation in this phase, in this transition?
Sure. Let me go back to this diagram again. Or maybe I'll do this one is a more convenient way of looking at it.
Mm-hmm.
So this is
I like that one. Yeah.
This is
the traffic lights. I love the traffic lights. Yeah.
So, I mean, broadly, this is one of these charts that, I mean, it doesn't change. I mean, this is just our template to explain what you do in each different phase. And, the fact is it's bound to be precisely wrong, but it's going to be approximately right. And that's how we tend to view it. So the way to read it is that assets are shown on the left, industry groups are shown on the right-hand side. If you're in rebound, and you read the traffic lights like a typical traffic signal, and, green is go, red is stop, amber is proceed with caution. And what you do is in rebound, you want to basically take on a bit more risk. You want to, don't go all in, but begin to build risk. You want to go definitely into equities, definitely into credits. You don't want commodities, and you don't want bond duration. Think back to late 2022, through first half definitely of 23. That was the correct asset allocation for that phase. Then you move to calm. In the calm phase, you're beginning to see evidence that economies are bottoming out. You want to take a lot more risk. You want equities still. You want to be taking some of your credit exposure down, not necessarily because credits won't be good performers, but the point is that probably they've seen some of their best gains and there's better things out there. Commodities are going to start to move up. Bond duration's still way too early. Speculation, you then start to take risk off. That's where we are now. Okay, so we're not completely risk off. We're reducing our risk, proceeding, with more caution. Equities, same idea. We're not out of equities, but we're basically proceeding with caution. Credits we are out of. Commodities we're still into. Bond duration we're moving into with some caution, but moving in that direction. And then turbulence, if you look at that, you don't want any risk. You don't want equities. You could move back to credits because by that stage, maybe spreads have begun to widen out a bit. So there's decent compensation. Commodity markets, no. Bond duration, yes. And then equally, if you look at the industry groups, the same thing applies. You want cyclicals in the rebound and calm phases. That's the upswing of the liquidity cycle. You want defensives in the speculation and turbulence, the downswings. You want to be around mid-cycle when the liquidity cycle is above average. You want energy commodities, which is the phase we're principally in now. Financials were great in calm, not so good in speculation, and probably terrible in turbulence. And if you're in the turbulence phase, you really want defensives. I mean, that's the thing that's going to help you the most, and holding, more cash, etc. Now, this is a portfolio, as we say, that is a tactical portfolio. What people have got to do when they're investing is to have a core portfolio that you own and don't trade, and a tactical portfolio that you will trade. This is the tactical bit. So we're reducing risk in the tactical bit. In the core portfolio, you've got assets that are likely to perform over the very long term. And over the long term, as you probably heard me say, you do want gold, you do want prime residential real estate, you do want some Bitcoin, and you do want good quality equities that have got pricing power. Because in my view, we're in a long-term monetary inflation, courtesy of the fact we've got so much debt. And the only way to get out of that debt is effectively to monetize it. And that's the reality. Until somebody comes up with a better solution, that's the way the world is evolving into a monetization one. I don't believe this line about financial repression. I think that's misguided. I think we're in a world of monetary inflation. It's as straightforward as that.
Mm-hmm. Okay, so one way I kind of think about liquidity, and you can push back on this, like a tide or something. We've already seen the peak. Now it's starting to go out. So if it's going out right now, maybe people feel fine. They haven't noticed it fully yet. But what do you say, Michael, would be some of the biggest risk in your mind once that tide really does go out? Like, what are the things that are going to get exposed that won't be they won't be very pretty?
Well, let me give you a couple of examples. This is, maybe I just need to go back to this chart. This is the way that the financial system works, okay? And I'm sure I've gone through this before because this is really at the heart of our analysis. Essentially, financial markets today are not new financing mechanisms. They're basically debt refinancing systems. And that's a very important difference. It's not the textbook view. It's the real view. It's what is actually happening. 80% of transactions in financial markets, primary transactions, are essentially debt refinancing transactions. So in other words, what this is saying is at the heart of the system, there's a debt liquidity nexus. And what this really means is that you've got to roll over debt. Debt doesn't go away. It's never repaid. It's just rolled over. It's refinanced. And that refinancing needs liquidity. Okay. Now, if debt needs liquidity, liquidity needs debt. And that's the paradox, because most lending now is collateral based. According to the World Bank, and we say that in the top left, 77% of all global lending now is collateral based. And that means that essentially, if you're looking at financial market transactions, you need a US Treasury of some form, a bill or a note or a bond, to post to a credit provider in order to borrow. Okay. And that's the way it works. In a home mortgage situation, you basically put your bricks and mortar, or you post that as collateral for the lender. So there's various examples, but those are probably the two clearest. So debt needs liquidity, liquidity needs debt. And what we show on the left-hand side of that is that where you get a derailing in the transformation of debt into liquidity occurs with breakdowns in the repo collateral markets. And so that's what you've got to look at very closely. And if I show you that, here are two of the most prominent indicators. One is the move index of bond volatility. Okay. Now, why is that so important? The reason it's so important is that this governs the collateral multiplier, or another way of putting that is the haircut that credit providers will give a borrower in the repo market. So if there's a lot of bond volatility, the collateral that you're posting, the Treasury bond or note or bill, well, most likely note or bond, in fact, is going to be more volatile. And therefore you need a bigger haircut so you can't borrow so much. So if you get very low volatility, it's great, and you can borrow a lot more money in a low volatile environment. So the system is very pro-cyclical. But this is a sign of it going wrong if you see spikes in the move volatility index. Now, it's my view, and I've got not a lot of proof for this, but anecdote and maybe common sense, is that I think the Treasury and the Fed are targeting the move index because the basis trade among hedge funds is so important to them that they can't let that derail. And if there's heightened volatility, that basis trade will disappear or contract very quickly. And so I think they're trying to control that, and they can do it through buybacks, Treasury buybacks, among other things. A lot more bill issuance, for example, are two routes. But that's essentially one thing to look at. And you can see there's been a recent spike, but that spike came down quite rapidly. And I think that was an engineered retreat of that index. I may be wrong, but that's my view. If you look at the next indicator, that's looking at something which is the SOFR spread against interest on overnight reserve balances of banks. You could use Fed funds, but this is probably a more convenient measure. And this is looking at whether you're outside the normal zone or not. And this is basically demonstrating what that spread normally is. So this is really showing what market rates are doing against what the Fed is aiming at. Okay. Now, if the Fed loses control of interest rate setting, you'll start to see this series spiking, which it has done. You notice those big spikes at the end of 2025. They were sufficient to cause the Federal Reserve to introduce this new QE measure called Reserve Management Purchases, RMP. And those have actually totaled about maybe quarter of $1 trillion so far. So they're fairly meaningful. But the Fed has actually helped by adding a lot more liquidity to markets. And I can show you that here. Now, this chart is again looking at that SOFR spread in black, but here it's flipped over, so it's upside down on the right-hand scale. And the orange line is my estimates of what excess reserves are in US banks. So 0 means on that left-hand scale, no excess reserves, deficient reserves if you're negative, and above average if that orange line is above the 0 line. So what you can see is that since early December of last year, there has been an increase in effective reserves in the US banking system by as much as $600 billion. I mean, that's a big jump. And that has clearly, unambiguously helped the markets. If you hadn't have had that, markets would have been a lot weaker than they have been.
Interesting. Okay. Wait, I want to go back to the move index. Is kind of like, I don't know, it's like a policy for the Fed and the Treasury, I guess, capping it in a way. I mean, allegedly.
Yeah, I think they are capping it because it's such an important variable within the system.
Well, what would happen if they didn't cap it? I mean, allegedly again, but yeah.
Yeah, if they didn't cap it, what you would see is you'd get heightened volatility. That would mean that you would get the basis trade, where hedge funds are arbitraging between the cash market and the futures market, would shrink very quickly because you don't want to hold leverage positions in a highly volatile environment. That would shrink. That would cause treasury yields, cash yields to start to blow out. And that would cause funding problems for the US.
Because all the collateral, that's all the collateral then.
Well, well, first of all, it would hit the treasury market. So they don't want that. But then equally, you've got one effect, which is hitting the treasury market, making it much more expensive for the federal government to borrow. And it would, because the treasury market or the yield on the treasury note is such an important benchmark, that would affect many, many other assets. But then the other point is that it would affect leverage within the financial system because there's a lot of collateral which is posted and people borrow against that. So you would simultaneously have the value of collateral shrinking, okay, because yields would go up. And at the same time, because you've got heightened volatility, the haircuts on collateral would increase and the collateral multiplier would come down. So the pool of collateral and the multiplier would shrink simultaneously, making the system highly pro-cyclical on the downside.
Another area I would love to bring up with you, and you have talked about this in prior interviews, is this like debt maturity wall coming due. I think we talked about this a couple of years ago. Where are we when it relates to that?
Let me try and articulate that. So this previous chart showed the debt liquidity nexus, and economists tend to speak about debt relative to GDP. I think that's meaningless. I don't really fully understand what that means, apart from the fact that it's just saying that the economy is sitting on a big debt load and it may cause economic growth to slow. But it's not really a financial risk per se. Financial risks are much more about whether you can roll the debt over. And that's what can cause, if you can't, that's what causes a financial crisis. So if you look at the ratio between debt and liquidity, you find there's an equilibrium or seemingly equilibrium. And you can see that we've charted here the debt liquidity ratio using IMF data on debt and our data on liquidity since 1980. And that comes out an average of about 200%. So in other words, 2 times debt to every 1 liquidity. And what that's saying is that's the harmony or the equilibrium level where the system can cope quite well by rolling over debt. Now, if you start to go up on the scale, so you get to 210, 220 on that left-hand scale, you start to get refinancing tensions. There's less liquidity available to finance more debt. And what that's saying is that's when you get financial crises. And all financial crises I can think of going back, which we've annotated here, have been refinancing crises in some form. And central banks' reaction to that has been to come in quickly and pour more liquidity into the system to reduce the debt liquidity ratio. And that's how they've responded. Now, the other side of that is then to say, well, look, if you're on the lower part of that chart, when you're down at 170, 160 even, you're very low with the debt liquidity ratio. So there's abundant liquidity. It's not all going to be used. And so that surplus is going to find its vent somewhere else. And that vent tends to be asset market increases. So you tend to find bubbles occurring when you get very low debt liquidity ratios. Now, we have just come through what you might call the everything bubble. And you can see there on the chart, this is a huge, huge anomaly relative to normal experience. And the question to raise is, why is that going on? And there's two reasons. Number one is that you saw every crisis response being more liquidity every time. 2008, throw liquidity. COVID, throw in liquidity. Repo problems at the end of 2025, throw in liquidity. That's the response of policymakers, okay? But the other thing they did is they also slashed interest rates to near zero levels, and in some cases, in some countries, negative. Now, I tell this story sometimes, which is an interesting point to ponder, is that when I was at Salomon Brothers, the book that everyone read, at least in research, was A History of Interest Rates by Sidney Homer, who used to be head of research at Salomon Brothers. And this was a tome that examined interest rates through 5,000 years of history, okay? Nowhere in those pages is there any reference to zero interest rates, okay? Or not even negative, not even zero. I mean, nothing like that. Way off the scale. So this shows what an anomaly we've just come through. And if you have zero interest rates, what happens? You want to borrow money. So we get even more debt, which compounds the problem. And what's more, if you're sitting on debt that you've taken out at 5% or higher interest rates, you're going to want to refinance that pretty quickly at zero or whatever you could get. And so what happened in the post-COVID period was there was a lot of debt, there was a lot of terming out of debt into the latter years of this decade. Now, you can see the so-called debt maturity wall, which is that money coming back. Now, this is not new debt. This is the old debt that needs refinancing. And this is basically saying what the refinancing burden is each year. Now, that's not dramatic enough. And that probably is better because this shows the change in that series on a yearly basis. And this shows that the COVID years saw this huge drop in refinancings because debt was termed out to the latter part of the decade. And so what you've got coming back into markets now is a lot of debt that needs refinancing. Now, that's a burden for financial markets. And I come back to the point that I keep saying is that all money that is anywhere must be somewhere. So if it's in the real economy and if it's being used for debt refinancing on top, it's not around for buying equities or risk assets in the same way as it was before. If you're in an abundant liquidity environment, sure, the vent is going to be risk assets. And that's really the problem we face. On top of that, and I show this chart and just focus on the orange line for a moment. This is looking at the demands from new capital raising for US financial markets. So this is not the existing debt refinancing itself. This is the new debt that's coming on. And this is basically a combination of the federal government because of increased outlays. I mean, this is actually even, I estimated this even before the Iranian tensions. So you've got more spending coming through for defense. And on top of that, you've got the big capex outlays from the AI investment. And so, what you're looking at is a significant increase in demands on markets, capital markets. And that's the reality that we've got to face. So these are the problems that are that are out there. And the way to monitor is to look at the move and to look at SOFR, IRRB spreads. Those are going to give you some measure of risk control in markets to see if these things go awry.
Based on where we are now, what's your expectation? Do you see these becoming a major problem? And are we already seeing warning signs?
Well, I think we are. I think that's a problem. I mean, the interesting question will be how the Federal Reserve responds to these. I think it's very difficult to gauge what they'll do because there's still a great preoccupation within the Federal Reserve. And, I'm not singling out the Fed, but only because they're the leading central bank. But let's say among all central banks to say that interest rates are really the key thing that they watch. Now, there's clearly a lot of legacy there. But we're in a world that's really changed, aren't we? Because, if you pick up a textbook and you say, well, what role do interest rates play in an economy or a financial sector? The answer is that interest rates are there really to, balance borrowers and lenders. And effectively, what you were looking at is they were balancing a situation where households who were principally the lenders to corporate borrowers who were basically borrowing for capex. So if you increased interest rates, savers would save more, households would save more, and investors would buy less capex. If interest rates are low, the reverse would happen. Now, we're not in that world anymore, are we? There's not a lot of capex which is really going on in terms of people are borrowing at certain interest rates. I mean, there's some clearly, but the vast bulk of capex is now done in areas like China, where it's state directed, it's not influenced by interest rates. And what's more, the sector that is borrowing most is not the corporate sector, it's the government sector. And in actual fact, what interest rates are really telling us is much more than what they're really governing is the transfer of interest payments from the government sector to the private sector. It's the private sector that's in big surplus overall, corporations and households. So the point of what I'm saying is that if you raised interest rates in the old world, the old textbook world, you would slow the economy. In the modern world, if you raise interest rates, the government is paying out more income in interest payments to the private sector through transfer payments. So you're giving the private sector more income if you raise interest rates. Well, surely that's a stimulus, not a contraction. So the whole thing has gone topsy-turvy. And that's why, we're almost in an Alice in Wonderland world in many cases when you're comparing the real world with the textbook world. And that's why it seems so puzzling. So raising interest rates is not necessarily, or cutting interest rates, is not necessarily the right lever to pull. What central banks should be doing is basically lending in crises, lending at high interest rates, in fact, against very good collateral, which was the recipe that a gentleman called Walter Bagehot, who was the doyen of central bankers, of probably the first writings on central banking back in the 19th century in Britain. And that's what he said. The trouble with our policymakers now is they're lending lots of money at zero interest rates against no collateral. And that's crazy. And that's why policy has been so bad.
Huh. Like, as you point out, the world has changed. Okay. What would happen? What would happen if they followed that playbook, Michael? What do you think would happen?
Well, I think there would be an uncomfortable situation where there would be defaults, but it may well clean the system out. You'd have to do that carefully. And I think that's why, if you maybe come back to what Kevin Warsh, prospective Fed chair, will do, there's a lot of talk about the Fed slashing the size of its balance sheet in some sort of, maybe there's some nostalgia there for small balance sheets, but I just don't think that can be done. I don't think it's practical. And, what they envision is that the private sector will take over that liquidity provision from the Federal Reserve. And by reducing restrictions on banks, you will generate a lot more liquidity within the private sector. And effectively, the Fed's footprint will shrink, but correspondingly, the private sector's footprint will grow. Now, I think those are welcoming words for sure. We don't want an economy dominated by the state. But I think at the moment it's impractical, given the fact that I don't believe that the private sector is yet of a size or capability where it can support the federal debt markets, the Treasury market, which is the all-important market in the financial system. You still need the Fed for that. So what I'm getting at is, although there is this ongoing debate in the US, maybe in more academic circles or in fixed income circles, to say, well, okay, what is the Fed going to do when Kevin Warsh comes in? Are they going to slash the balance sheet and reform the banks? Whatever. I think the interesting point to ponder is that what happens if those don't occur at the same time? So in other words, what happens if the Fed stroke Treasury decide that they're going to reduce the restrictions on the banks? In other words, enable the banks to hold lower required liquidity levels so they can lend more almost immediately. But they don't do anything about the Federal Reserve balance sheet for several years, and this is a long-term aspiration. Now, that may be a route out to enable more liquidity to go into markets. If that happens, I'll come quietly, and as they say, if the facts change, then one can change one's view. But it hasn't happened yet.
Probably not likely to happen.
Well, I mean, I haven't heard it. Yeah, I mean, this is a speculation.
Mm-hmm. I think the last couple of times we had spoken, you had brought up this kind of Treasury QE dynamic. Mm-hmm. Where do we stand as it relates to that dynamic today?
Well, I'll show you the picture. This is the data. Now, one of the things that I said is going on, maybe when we last spoke, was something that we have described as the transition from Fed QE to Treasury QE. Now, this is again a little bit of a wonkish notion, but let me try and bear with me and I'll try and explain what's going on. The Fed can increase liquidity into markets, okay, either through expanding its balance sheet or more particularly through changing the structure of its balance sheet by putting more weight on liquidity creating elements within the balance sheet. Okay, that latter part is what I've dubbed not QE, because the Fed used to say, well, it's only when the balance sheet increases it's QE, but that clearly isn't true. But you've got these two avenues. And what the chart you can see shows is that the red part is Fed QE. The orange is this little more subtle bit of changing the composition of the balance sheet to increase liquidity. And so what the Federal Reserve's elements are the orange and red parts of that chart. Now, that was something that used to occur, clearly in size. The administration is uncomfortable with that because their view is that this gives the Fed both a bigger footprint in markets and more particularly it's like sort of, somebody holding a fire hose and everybody getting absolutely drenched in terms of financial asset markets. It's undirected and maybe ill-directed because it creates wealth for the wealthy and leads Main Street America, parched and needing more support. And so the administration wanted to shift away from Fed QE, and what they devised, in my view, was what I call Treasury QE. And that was basically saying that what we're going to start doing is changing the calendar of Treasury issuance from longer maturity notes and bonds towards very short-term bill issuance and short-dated note issuance. So, focusing very much at the short end of the term structure. Something that Scott Bessent criticized Janet Yellen for, but now he's very much focused on that because I think it's convenient. The attraction of doing that is that if they change the calendar of issuance towards shorter duration debt, who buys that debt? It's the banks. And if banks buy government debt, that's called monetization. And so there's a lot more monetization going on in the US economy. So effectively what this is telling us is that black area is the route towards more printing money in the US, but it's printing money that is going directly into the real economy, not into financial markets. And if you look at the little window that we put on the chart, that's showing the impact of that Treasury QE on the US ISM survey, and the black line is the 12-month change in the ISM. So, I'm not going to hold that this is going to win the Nobel Prize for statistics, but it shows a pretty decent correlation and seems to support the idea that maybe there's more stimulus to the real economy going on this year. Now, one of the other interesting points, which is worth dwelling on because you raised the question of Bitcoin, is does this have any impact on Bitcoin? And so I drew this chart, which is looking at that stimulus again with the 6-month change in the Bitcoin price. And that's suggesting that you may get some stabilization coming because of this expansion from Bitcoin. But, I'm not going to press this too much, but it's an interesting point to kind of consider that maybe this is another route to increasing more liquidity within markets, and Bitcoin can benefit from that. But generally speaking, what really matters for Bitcoin is liquidity. And this is the more common liquidity measure here shown in black, shown as 6-week changes. And the BES ticker at the top is Bitcoin, Ethereum, Solana, a cocktail of those three cryptocurrencies, 60% Bitcoin, 30% Ethereum, 10% Solana, shown again 6-week changes in the orange line. And we've advanced the black liquidity by 13 weeks, 3 months, to show that it has a good lead time. So, the rally you're seeing, the firming up in cryptocurrencies is not unexpected. The question is what comes later if you've got this weaker liquidity environment.
Michael, I have to say, you are one of the smartest people I get to talk to on this channel. I'm going to go back and rewatch this interview because every time I have you on, I learned something. I love how generous you are with sharing your charts with this audience. I know this audience absolutely loves hearing from you. So before I let you go, let's leave this audience with some parting thoughts. Let them know how they can find you and find and support your work. I know you have a Substack as well that folks can subscribe to. And anything that you would like to leave this audience to think about, the floor is all yours.
Oh, it's very kind, Julia. I'm just a bean counter, so don't I don't want to big me up too much here. What this is really saying is ultimately you've got to watch liquidity. You've got to count liquidity. I mean, that's the beans that we look at. We count liquidity, and that is what we think is important in terms of the system. All I would say is that don't take one piece of evidence. Look around. That's what we're really trying to say. We can be wrong as well as being right, but we've got a systematic approach to what we're doing. And we think liquidity is all important, but you've got to get corroborating evidence. That's what I've tried to show here. So we're trying to relate the position of the liquidity cycle to where we should be in equity markets. We're looking very much at what sectors are doing to get that corroboration. We're looking at what the fixed income markets are doing to get that corroboration. And then we get a final cross-check from what the real economy should be doing. So that's the picture I tried to paint. And everything lines up for a speculation phase right now, which will ultimately evolve into a turbulence phase. So that's where we are. If you want to read more, the Capital Wars Substack is probably the best way to do that. We produce both narrative and data in that several times a week. Or if you're an institutional client, we have all our data is available. A lot of quant funds use our data. We produce presentations or whatever for institutional clients. And that can be found on another website, which is glindexes.com.
Michael Howell, CEO of CrossBorder Capital, author of Capital Wars. It has been an honor having you back on the show. It's been way too long, and I just really, really appreciate you, Michael. And thanks again for being so generous with your time, all of your knowledge, wisdom, helping all of us learn and get better, and teaching us about the importance of liquidity. Really, really appreciate you.
Well, it's very kind, Julia. Thanks so much. Enjoyed it enormously.
Thank you.